All right, guys, here we go. In today's video, we're basically just doing a quick follow-up to the real estate video we did about a week ago, comparing the current housing market to that of 2008 and some of the similarities and differences. But anyway, as you can see where that gold arrow is, we had a real nice potential breakout. Well, we did close over this little pennant formation, but you really need follow through, for anything to count. And then, real quickly before we get going, let me go back. And I've talked about this many times, but markets never crash, pull back, collapse, whatever you want to call it, without there being hints and things on the chart to actually show, the bad health of that market. Okay. And as you can see, back here in 2006, uh, with this XHB, I'll get it out. It's basically the Spider Trust ETF for the home builders. Okay. As you can see, we had all this sideways consolidation, and the only time price consolidates, there's only two reasons for it. One, the big money is accumulating, buying up shares for a potential breakout, and they're slowly doing it so they don't, pop the price to the upside too quickly, or they're selling off so slowly in order to get the best price for their shares before, yeah, they drop it. And as you can see here, we were in what's called an inside bar, everything trading inside this one bar. A little white line there showing the bottom, boom, broke down, and then, the rest is history. And that market, the housing market, uh, with the XHB ETF anyway, dropped, over 80% here to the lows. However, before we got there, it didn't, go just straight down. We had a pop here, back up to the upside, and hit this little high pivot area before we finally rolled over. And as you can see, it bottomed in January 2008, and then it ran back up. Okay. And then starting at the end of quarter three, first quarter four is when we finally had the big rollover and crash. And then you add to that, how long it took to finally break up and over, that recent high price level. Yeah, it took really to September 2012. Okay. Now, what was going on here starting back 2006, 2007, well, actually 2005, 6, and 7, was that there was over $1 trillion pumped into the real estate market via bad loans, shoddy loans, not, truly qualifying people, making sure that they had the required, salary, income, and also down payments in order to verify their ability to take care of that mortgage obligation. There are a lot of boutique, mom and pop mortgage companies that popped up, and people lending money just to be lending money, with very little, contingency policies, for delinquency on those loans. And like I was saying, you look it up, it was over $1 trillion each year in those type of shoddy loans. And, current market, yeah, we did have the COVID slam down, and then the run up in pricing in a lot of markets, quite honestly, very overpriced, according to a lot of factors. And that could lead, to people, getting hurt, near time, um, meaning over the next 6 months to a year. And so that is going to be a leading, factor, as well as, of course, a little bit higher interest rates coming on as well. But the main thing is that in comparison, the recent loans, or over the last number of years, mortgage loans that, of course, they've been a lot stricter. I mean, you can ask any mortgage originator. It's a nightmare to get people, pretty much a nightmare getting people approved and qualified and everything for loans. So that should really curtail and slow down a lot of the foreclosures. But over the last, 2 years or so, with the escalating prices and people actually paying over market per se, or for example, like a car paying well over the MSRP, that's gonna, those folks, I'm not speaking for them. I'm just saying it's probably a lot easier to walk away from a house when you feel like you made a bad decision, and I don't know what their headspace is, but if with job loss or you know, uh, people cutting back on salaries, different companies are actually cutting salaries in order to, at least keep people employed. And you qualified for a loan making X number of dollars, and now it's, 10, 15, 20% less, then, that's going to put the higher odds of people walking away, giving up, whatever the case may be. And then also, as you see here, we have starting back in 2018, before the recent, pullback, and I'm talking about current day now, going into 2022, about a year ago, we could see potential pullback in the markets. Okay, so we had the big slam down here in the COVID months, and then basically a V-shaped recovery, came back up, and then these trend lines, normally you'll hit them 3 times, bounce, and then the fourth, fifth breakthrough, just as we saw here. And this is important. You were under the 20. So you had two factors. Whenever you have two factors on your side, that gives you 83 to 87% probability odds. And that's really all this is probability and odds, but you got to know what those are in order, put them on your side. Anyway, either to the upside or downside, you have two more factors, and you have that 83, plus percent favor, odds in your favor that's going to continue in the way that you believe it is. And that's kind of where we are now. And as you see here, we've been holding this uptrend line for a while as well. Not saying we bottomed out by no means, but just, saying that we might not be as bad off as yet, okay, as people are saying out there. Now, time will tell, and we'll know, over the next week or two, if, how hard this market's going to move up or just roll back over, because we do have some overhead resistance here coming in at this high pivot there. And as price moves up, there's really only three things to help it or hurt it, okay? And that's going to be a high pivot or low pivot, a previous support or resistance zone that will now be obviously resistance as you come up, a moving average, and then a fib line. So, and then the more of those three factors that you have in a general region or stacked on top of each other, that is what gives you your factors regarding uh, calling a support zone or a resistance zone as you're pushing up. Now, just because you hit a resistance zone doesn't mean you can't break through it. It just might have to pull back in, like a higher low. And what I mean by that, this is, a low, and up here was a higher low because we have broken out. So let's go ahead and put a couple of moving averages on there, because right now we have one factor, this high pivot for a potential resistance zone, so, and may cause price to pull back. Now, the two most important, in my opinion, I can, on another video, I can show a bunch of reasons why the 20 and the 200 two most important moving averages on the chart. But let's go ahead and put the 50 up there. And as you can see, we haven't been above the 50 since we broke down back in January of 2022, over a year ago. And here we are back over it. Of course, we tried here, got rejected. We were over it here on the week, but got sold off. But we did actually close over it last week. Now, we do need to put in another, at some point, like we could pull back under it and get back over, but we need 2 weeks here. Closes above the 50 in order to confirm, a potential move to the upside. Let's go ahead and look at the 100. As you can see, it's obviously right here. So we have if we go ahead and do move up, we have two factors, pretty close proximity. This red dashed line might as well say 66.70, and then 68.50 is about where our flat uh, well, 100 simple week moving average. And the reason why I'm emphasizing the word flat is when the moving average starts flattening out, especially 200, but let's just talk about the 100 now. It's very hard to get over, or if you're coming down, it holds support pretty well. So two areas here, it's going to be, kind of tough to get up and over. So let me see if I can draw this out for you. Okay, finally it clicked. It kind of went up, down, up into this region, and then come back in. Now, what's going to make the difference is that if we keep above this previous low pivot, see that blue dash line? If we keep above that and turn, we could very well, be on an uptrend to be able to break out and get over this, high pivot area plus the 100. Okay. And then more importantly, if we, move up and come back in and the 20, see, I was telling you that's, one of the two most important moving averages on the chart. Doesn't matter if it's a 2-minute, hourly, daily, what have you. But anyway, as this starts coming up, if we come back and nail it, and I used to like to use a comparison, if price can hit it and stick like an Olympic gymnast, and then we get one of these green candles like that, then yeah, you have high odds, high probability going to run up here and slam through all this overhead, resistance. Okay. And, should we be able to do that? There's another indicator that, we share with our Patreon members. It's actually right here, lines up with this high pivot red dash line. So we actually have three factors right here. And if we do that uh, W that I was talking about, and it lines up, then the 20 supports us, then we have 83, 87% odds probability that we will, and I know this is going to blow a lot of people away, come back up here and retest all-time highs. Okay. So anyway, on that nail biter, I'll go ahead and let you guys go. Thanks so much for watching. Check us out on Twitter, and we will see you on the charts.